This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. And of course, we are coming out of yesterday, Wednesday, which of course was absolute carnage, absolute bloodbath as far as broader markets are concerned. So where does all of it leave us? That's the question, that's the debating point, which we will talk about here over the next 2.5 hours. Guys, hi, morning.
Hi, Prashant. Good morning. Nigel, morning. Well, yesterday was one of those days when you just were waiting for the day to end. That's the kind of carnage that you saw, right? And I'm sure a lot of individual portfolios must have been under a lot of pressure yesterday. But the only thing to remember is that this is a market that has rallied for 1.5 years non-stop. So at some point in time, I mean, nothing goes up in a linear fashion. So at some point in time, some give back has to happen.
Well, that's right, Sona. Everyone was only waiting for the final bell yesterday. The stop loss was 330. And that's the only one that people are looking at. But I'll tell you what, in the next few days, you're going to get a chance to buy some very good quality mid-cap names. And if you are asking for that dip, you've got it. Hopefully, you don't get a larger one. But, select mid-cap stocks that have fallen. I'm not talking about the small-cap names. The mid-cap names, some of them, they're going to be approaching those attractive levels.
Absolutely. And I think that's what one should stay focused on, which is the slightly longer term. And it's very, very difficult to do because psychologically, the impact is very large. And portfolios are, of course, also feeling the heat. But you've got to keep the goalpost a little further away. Now, let's just quickly tell you, where we are, right? And I think let's just start by taking stock. This is the three indices, the Nifty, the mid-cap index, and the small-cap index from the highs that we saw and, on your screen. And, same time yesterday morning or day before morning, you had a situation where the Nifty had lost 10%. The small-cap index had lost 10% from the high, and the Nifty was actually just 0.5% away. So basically at all-time highs. Nifty Bank it doesn't make sense to look at it because it never went back to its previous high in this entire cycle. But yesterday, the Nifty also caught up. So Nifty is now, after yesterday, down about 2% from the highs. And of course, the big one is the small-cap index in terms of the correction. Now, yesterday was the sort of first, not yesterday actually, this particular phase is the first proper correction in small cap since this rally began. When did the rally begin? It began in March of 2023. If you remember, 31st of March 2023 was the absolute low, and then the market started going up non-stop, right? And we've had pullbacks, but they've lasted 1 day, 1.5 days at best. They've been in the magnitude of 2%, 3%, 4%. We remember that, and then the market starts to continue to rally back up. The question, and we'll get to that in just a bit, is it going to be something similar or maybe a little more prolonged? Now, carnage in the broader market is what we saw yesterday. Market breadth was extremely negative. Declines outnumber advances 14:1. So very, very hard to actually find. Forget about big gainers, any gainers in a market like what we had yesterday. Now, I just want to say something at the outside. Fundamentally, nothing has changed. I mean, you're talking about, you want to talk about earnings, you want to talk about the quality of companies, you talk about growth prospects, growth in India at a broader macro-ish kind of level. All of that remains absolutely intact. So I think that is an important thing to remember. What is happening is some of the excess and froth in the system is getting cleaned out. We've been making this point for the last many days. And, if you remember, many are talking about the SEBI chief's recent comments on camera. But the first time, she highlighted that there is some froth building up in the broader market was that letter to AMFI. This is about almost a month ago. And we said, well, pay attention to it. Because, I mean, it's extremely unusual for the regulator to voice concerns like this. They're doing it, better pay sort of attention. And that largely was the top of the market. So important to remember, this is some excess and froth in the system getting cleaned out. The old market adage, prices move and reasons follow. And we all know so many, reasons which are being given about why the market is down. And I'm not going to go into all the details because it's well discussed now. But one important technical reason, apart from everything else, which is the fact that, regulators saying there is maybe a little bit of froth and they want to cool things out. There is the RBI action, which is being discussed. Forget all of that. And of course, the fact that valuations, etc., in certain pockets had absolutely gone to absurd levels. There is also the March tax harvesting. March is the tax harvesting month. So it's an important factor. And that will only come to a close by the end of this month. So there is some time to go there. Expect pullbacks along the way. When I say pullbacks, some rallies along the way as well. It's not going to go one way. But I would say that things could take a few more days to actually settle down. The mood in the market for the last 1.5 years actually has been to buy every dip and you make money. That may well still be the case, but the question is, how much is the dip? It's not. This one is not a 3-4% kind of a 2-day, 3-day kind of a sell-off that we've had in the past 1.5 years. It could maybe be a little more prolonged. So one will have to be patient. We are, technically speaking, already getting into the oversold zone, right? The Nifty RSI is at 46. Small cap RSI is of yesterday. Daily RSI yesterday is at 24. But again, small cap is a very varied space. Better to look at RSI on the Nifty, and perhaps there is some more pressure because on the Nifty we've just about started to come off a little bit. I would say start to make a list of attractively priced, good quality, mid and small caps to invest for the long term. You don't have to do it today, but I think it'll, some of these things will happen pretty quickly, but you've got to be ready. Not just with, of course, the cash, but of course also with what you want to do, and you'll have to be decisive over the next few trading sessions. Just a quick word, and I'll just wrap this up quickly. Overnight equities were were a little soft. S&P was down a little bit. Nasdaq was down 0.5%. The 10-year went up to about 4.2%. Oil's up about 3%, so that's a meaningful rally. And copper prices, which we'll discuss more, that spiked to 11-month high. Supports on the Nifties, the 40-day exponential moving average. Watch on the downside, that is about 21,959. Below that, further downsides open up. And, the support is there's an ending diagonal pattern, which we can talk about later. That got broken yesterday. It's not a great thing. It's not actually. It's a pretty poor technical signal for what is to follow. It's only once happened before, back in 2007-8. That now becomes a resistance, which is 22,135. We left off just under 22,000. So that's about 150 odd points away from where we left off. GIFT Nifty will come up on your screen. It's indicating a flattish 30 odd point lower start. Sonia.
Oh, absolutely. And, one must not forget, right, that this rally has also been relentless in the last 5 months. If you just pull up the Nifty chart, you'll see from the lows of 18,500 in the month of October, we are sitting at 22,500 as of last week, which is a 4,000-point Nifty rally that we've seen in 5 months. So some give back, some, taking off of positions had to happen at some point in time. It was just a matter of time. I mean, you look at that relentless move, right? Having said that, yesterday there was large selling that came in from FII, so foreign investors. Almost $2 billion of FII selling. So if you adjust for the ITC block, then FIIs have sold 15,600 crores in the cash markets in one trading day. And this is despite large caps not falling as much. So there could perhaps be more trimming of positions in the days to come. Don't rule that out. The focus should now be squarely on large caps and on good quality mid-cap names. That's the only way to approach this market when it is falling so relentlessly. A couple of things to watch out for. Some of them Prashant has already mentioned. There is the advance tax payment on the 15th of March. There is, of course, squaring off of positions that happens end of year as well. And sometimes when that happens, the market sell-off continues. So that could be one of the reasons. There is the MF stress test that will happen on the 15th. There's the FTSE rebalancing that happens on the 15th as well. And that could lead to some flows coming into HDFC Bank. And if you map the trajectory of HDFC Bank in the last couple of days, you'll notice that there is delivery-based buying that you are seeing in large cap names like HDFC Bank. Another important internal to look at is the PCR, the put-call ratio, which has fallen to 0.65, an indication that the market positioning at this point in time is a bit on the lighter side. It's not very heavy, an indication that perhaps we are not in for such a bad run from here on. So this is some of what the technicals are suggesting. But for now, don't rule out the fact that there could be some more correction. The best way to approach it is to A, have patience, and B, look at some of the large cap and quality mid cap names. What are you tracking?
Well, if I have to look at the mid cap and the small cap indices, one out of the bigger factors, that's the advanced tax, that should be done by today or tomorrow. Yesterday that could have been partly one of the reasons why we did see selling, but that should be out by tomorrow itself, since tomorrow is the due date. Well, the biggest problem yesterday was the advanced decline ratio, and that should come up for you on the screen. You had 22 stocks that were declining for just one stock that was advancing, which was a bit of an issue. What did the FIs do? Well, they added short positions. They added close to 11,000 short positions. And I'll tell you what, I normally like when the FIs add some short positions. It gives you a bit of a cushion. If things go wrong, they'll have to, cover up their short position. But a market that's devoid of short positions is actually a problem, because then you are only relying on the cash market flows. And as we mentioned, that the FIs, they turn net sellers to a larger extent, X of the ITC block. And the short positions have now gone up to around 44,000 contracts odd. Not too aggressive, but shorts in the system is not a bad thing. That's the short point I'm making. The 50 DMA of two big parameters is what I'm looking at. The Nifty and Reliance Industries. So yesterday, both those two, they came closer to around the 50 DMA and they bounced off that mark. So as a reference point, I don't want either of these two to go ahead and break the 50 DMA. That becomes a bit of a reference point. So that's point number one. You track this data point very, very closely. The other one is the PCR. The PCR has come down to 0.65. Why is that? Because the call writing has become very aggressive. We saw aggressive call writing, and we normally point this out, right? The PCR, when it goes to around 0.65, to around 0.7, 0.63 approximately, that's a technical factor that plays out, and that's the reason why you could see a bit of a bounce. And just take a look at the call writing yesterday. You had close to around 2 crore shares that were added out there, and the premium crashed big time, 90% down on some of those strikes as well. So the bears are feeling very, very confident. Because of that technical indicator, at some point of time, I think from the day's low, we could see a bit of a bounce. We'll have to see the durability of that. But from the day's low, I think we'll get a bit of a bounce. The PCR has hit that lower end of the range. Support zone, 21,500 or 21,800. I already mentioned the 50 DMA for you. And on the upside, the 20 DMA, which was the support when we were falling, that becomes a bit of a resistance zone as well. The Nifty Bank, that ended pat in line yesterday with around the 20 DMA. So that's the crucial range I'm looking at. You don't want it to break that. But give and take everything, if Reliance Industries and the Nifty can defend the 50 DMA, and because the PCR has come down to around 0.65 odd, on the headline index, which is the Nifty, I think we could get a bit of an intraday bounce today. There's a weekly expiry that does play out as well.
Okay, thanks a lot. This reminds me, the fall that we saw yesterday reminds me of now people will start pulling out Warren Buffett and Peter Lynch quotes as well to make themselves feel better, right? One of them, right? Far more money has been lost by investors trying to anticipate corrections than lost in the corrections itself. So I guess this is a market for the patient, and patience is the only thing that can take you.
It's also a meme market, right? Yesterday somebody was telling me that in small caps, there are Buffett quotes. And in micro caps, there are Sadhguru quotes.
That's the only way to get you through this, right? Well, hopefully it was just a one-day blow. Let's see how things go from here. But interesting times for our markets. On the equities front, we have some views coming in from Venugopal Gare of Bernstein, who says that last week they highlighted that of the mid-cap 150 stocks, over half traded at a PE of over 40 times and a quarter above 60 times. Additionally, he adds several stocks were seeing downward revisions compared to upward revisions, and the gap with the Nifty has expanded to the highest level in the past decade, he says. The reality is that we are in a bubble, but a sound macro was stopping massive corrections. He believes the small corrections we have seen this week and in 2024 so far do not alter the valuation equation. They are still rich. Venugopal says it is tough to generate positive returns this year and brace for volatility. He says large caps remain a better way to express macro excitement.
Okay, well, guys, your money market views as well. This is Parul Muthal Sinha of Standard Chartered Bank, who says that the USD INR moved back higher in the 82.85 to 82.9 to a dollar range, driven by FPI outflows and a rise in the US rates. She says USD INR volatility remains low as we continue to see inflows being absorbed by local banks. She remains positive on the USD INR in the near term, driven by fundamentals and positive seasonality on trade deficit. She expects the pair to trade between 82.65 to 83 to a dollar in the coming week.
All right, and on the bonds, Dhaval Dalal of Edelweiss says Indian bond prices have been range-bound with a declining bias recently as investors passed through global inflation data and booked some gains. He says he continues to remain bullish. He expects inflation to trend lower at a slower pace, which should allow central banks to proceed with rate cuts. He expects the 10-year benchmark bond yield to trend towards 7% in the near term.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. But for the time being, let's run you through the list. We're looking at Tata Motors, Sona BLW, Precision, Uno Minda, Yes Bank, IFL Finance, Cyient, KEC International and DLF. All of them will be reacting to positive news flow, while you have Federal Bank and South Indian Bank that will be reacting to negative news flow.